What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is September 6th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, and I hope for those of you in the U.S. you had a great Labor Day weekend, because in today's Macro Monday, or Macro Tuesday for that matter, we are going to be talking about a lot of things. We've got to talk about the relative stagnation in Bitcoin's trend here, whether or not the bears have lost control, or could it be that people are starting to get excited for the merge as Ethereum and the ETH to BTC ratio is gaining serious traction into its upcoming update. And on top of that as well, I want to spend a little bit of time to discuss the broader macro perspective in equities. Have we finally seen the tail end of the sell-off, or are we likely going to continue with our narrative here that prices are generally going to be moving lower? Let's go ahead and talk a lot about it as we go throughout the video. And if you guys happen to enjoy it, consider dropping a like. All right, so on the TA side of things, let's go ahead and dive into our partner tool, CoinPanel. For those of you who do not have a subscription to CoinPanel, it's a tool that not only allows you to trade across a variety of exchanges in order to get the best deep liquidity for any trades on altcoins or major pairings, but on top of that as well, you'll be able to track our TA real time, even if you don't want to use it for trading. So this is a way where you guys can actually see my TradingView TA, my real swing trading technical analysis that we do here on the channel. But here in the Macro Mondays, we'll go ahead and dive through it here. The first thing I wanted to talk about again is the key resistance level, 21,700, that we got shot down at, which was again previous support, further validating that the bears are in control here. The 4-hour 200 EMA NMA is not serving as support anymore. That was broken, and we need to see whether or not it can be reclaimed or it will serve as resistance. So again, this is a bearish indicator here as of now. We'll see what happens. And then the third sign here is that we are expecting we're going to be coming down to $18,800. So let's go ahead and dive into the chart here. Now again, just to kind of visualize this here, we not only broke through those moving averages back here around 23,000 here in mid-August, but we used a previous range, that consolidation channel here, the previous band of resistance, yet again as resistance. We got huge amounts of distribution and sell side pressure here, and since then things have just been relatively neutral here. I want to even go ahead and dive in over into Bookmap here, one of our other partner tools, and just take a look at the market order flow here. As we've been pushing sideways, we've not only been generally setting in slightly lower highs and lower lows here. Really, I'd say that we're in a generally neutral channel here. We haven't seen crazy buy side or sell side pressure for the past week here. Since August 31st, CVD is neutral, right? We had a nice uptick here, up 4,300 here on the CVD, but take a look at what happens here with price. Even as market order flow is accelerating here on multi-book. This is one of the unique features on Bookmap that pulls from Bitstamp, Bitfinex, Coinbase Pro, FTX, Kraken, and really gets the deep liquidity of what's going on the order book for Bitcoin purchases and sell orders. And what we're seeing is that generally across the board, there is a no trend scenario here. Not many people are coming in to buy Bitcoin at these levels, and there hasn't been a major sell-off here, hence why we've been able to just push sideways here, and why it's so important to watch CVD here over time. Because if we're starting to see that, even as there's a lot of cumulative volume delta increase here, so we are getting market order flow pressure, if there's not much movement in price here, this means that there's a lot of consistent orders coming in on the order book here across the exchanges, meaning that someone is distributing. They're taking advantage of any kind of sense of optimism coming in the market. Anyone who's willing to buy the dip, essentially, they're offloading positions to prevent price from moving higher. Whether or not that's their intention or not, it's what they're doing. They're taking advantage of those buyers because they're looking to get rid of positions at these levels. And that is a clear telltale sign here. And it's also why, again, I highly recommend, if you guys don't have Bookmap yet, to definitely check it out. It's a good tool. They've even got as well a really exciting competition that I'm going to be participating in. It's not going to be starting this week, but it'll be starting, I think, probably next week, where we're going to have a ton of different traders essentially going in and trying to trade for a variety of prizes. And this is the link down below in the description if you guys want to sign up for it. It is the launch of Coinbase Derivatives' new Nano Bitcoin futures trading product. They're going to be doing a competition running from the 12th to the 16th to see who can win the most. There's going to only be 250 places, so if you guys haven't already, definitely register. There's over $3,000 in cash prizes. If you need any help on how to register throughout the process, there's not only the steps down below here at the bottom of the link, but also as well, there's a nice little video here that runs through the entire process. I'm going to be participating in it. I'm eager to see what you guys can do, who comes out on top. It's always for fun. There's no cost to really participate in it to any regard. So definitely consider checking it out, giving it a try, and on top of that, you don't pay any fees on trades. But diving back here into Coin Panel to do our technical analysis, I wanted to go ahead and emphasize one big thing. Well, we've been seeing Bitcoin since as far back here as August 27th pushing sideways. If we take a look here at Ethereum on its dollar chart, we're seeing a little bit of a different trend here. We're returning back to higher lows and higher highs. We can see that very clearly indicated here on the chart here. As we move up here, we're continuing to see the bulls take the trend back once again, or at least it seems here in the short term. But the one thing that a lot of people I think are missing, and again I think people are getting too optimistic on as we step into the merge. Again, everyone wants to buy into the hype and make money off of these big events. As you all very well know, it's usually buy the hype, sell the news. And what makes matters worse is that usually in a typical buy the hype event, and when you've got this major Ethereum upgrade or some other kind of network upgrade coming for a specific asset or cryptocurrency, we usually are seeing it break out to new dollar highs. But we are far away from those previous highs right now. We're still about $340, $360 down from the previous relative highs here in mid-August. And what makes matters worse here is that we've got to clear through a very important level here. I would not get optimistic on Ethereum here on its dollar value, which again in this market, when we're in a bear market, you do have to look at the dollar values here to see whether or not, even if it's outpacing Bitcoin, I need to know, is this something that I'm making a return on, right? The key thing here that we need to see cleared through is that 200-hour moving average. We've already done it for the EMA here. We can see that we've done that over the past few attempts here. But we got shot down back here on the 25th. And after that, if we weren't able to clear through that level, look what happened afterwards. We had a collapse of over $300 here in Ethereum's price, nearly 300 bucks here from top to bottom. And I do not want to get caught in a position where when I enter in here at a FOMO, I'm going to be taking a $300 loss. And of course, you employ stop losses, protective measures. But you get my gist here, which is that if we're already seeing this start to set in on the more wider scale time frame, still lower highs here compared to what we had back here in August, this is not looking as optimistic as some people are saying. Again, you can get caught up in the tunnel vision if you're just watching the shorter weekly viewpoint here, just taking a look at the hourly charts or 5-minute charts, and you see those higher lows and higher highs, when in reality, Ethereum does look a bit overextended. And on top of that, this range that was previous support in the past, right, which did get cleared through temporarily, is more acting like a deviation now, right? We deviated above that support line here, and we are now starting to see essentially that it's serving as resistance. The longer that continues, that is more confirmation that the buy the hype is already over, and it's time to sell the news. And again, I want to emphasize one thing here. The lackluster performance in Bitcoin mainly has to do with the fact that we're not only in a bear market, but a lot of the remaining optimism in crypto, any of the buy side liquidity is chasing this event right now. And when the event finally manifests, where does that energy go, right? And it usually, in most cases, fades out. It doesn't stay in the market. It's temporary. As we talked about, during bear markets, there are relief rallies, and there are catalysts or narratives that drive relief rallies. Ethereum's merge is likely one of those for crypto. So I definitely want to emphasize that, again, not to get carried away too much by this short-term optimism and not take excessive risk when we should be working on protecting our dollar capital here. And that has a lot more to do when we dive into the macro perspective. Now, even again, if you guys want me to take a little bit more of an optimistic tune here, the only potential upside I really see here for Ethereum would be coming up here towards its line of resistance, this long-term green band of resistance that's played out since 2016, or it's at least an important midpoint here on the logarithmic chart. But I just want to again emphasize again that this is a very high risk, high reward play here, and it would probably happen within a very short window of time here on the weekly chart. I'm not going to be making the trade. As you guys can see within CoinPanel, we don't have the chart up here because it's not something of interest to us. Now, we've delved into the topic of crypto, but I want to spend some time to clarify on the macro perspective why we hold such a grudge against doing any major speculative trades in crypto, right? I love crypto as much as the next guy. You guys know this, but it's again important to make sure we enter in at the right times. Let's take a look here at the S&P 500 futures. We've been ticking down since back here in mid-August here, since we hit the resistance on the 200-day moving average. As we've continued to tick down here, we're still seeing relative weakness here at a range where buyers really need to be coming in and buying the dip if the bulls are in charge here, proving the idea that we could potentially be setting in a significant higher low here from the previous one set back in June and July of 2022. Because if we cannot, we are likely going to set in a lower relative high here from the two previous ones here on August 16th and here on August 29th. And we are going to probably have a very fast-paced decline here going into the fall to retest this lower support band here around 3,100 to 3,200. And I think that that could be where we possibly get our bear market lows. It's not too crazy to think we could get there. A lot of people didn't think we'd come down to 3,600 when we were all the way back at levels like 4,600 or 4,800. It can happen a lot quicker than people think. Taking a look at the Nasdaq again, we had the clear deviation here. This was your sign to go short and to again take advantage of the optimism in the market, get out of positions, get into cash. And look at this, the two levels that we'd want to see some type of buy side support here, we are now starting to treat as resistance. Unless we can get back above these levels and make them support, the bulls are not in charge. And we've yet again seen another failed relief rally attempt where the bulls thought we were heading back into a new bull market. Now again, I want to make one thing clear here. As we've seen with previous spikes in the VIX that get up here to 34, as you all know, the VIX, if you guys watch the channel frequently in the Macro Mondays, the VIX is the volatility S&P 500 index, basically measures the volatility or implied volatility within options markets. And again, this is going to increase and spike when we see large declines in the market and the future outlook and uncertainty around price is continuing to expand. Generally speaking, we see that we have these little bump ups here in the VIX, and then we usually will roll over for a couple of days. I think we're already in the process of that, and we also saw an attempt here back on September 2nd. As we can see, there's a very tall wick on the candle. I think that we could very well see a slight decline here, and that can be maybe a day, 2 or 3 of this week, where the bulls maybe take control here for a short little while, get a little bump up here. But you all know what we focus on. We don't care about what's happening tomorrow. That's not what these Macro Monday episodes or today Macro Tuesday specials are about. What we're focusing on is what's going to happen over the coming weeks and months. Where are the big discount opportunities? And is this a good time for us to be riding the wave? Well, to be honest with you all, I think any kind of waves we've got are going to be crashing here. Essentially speaking, this is not the time to get optimistic. We need a full-scale spike up here, either not only here to 34 on the VIX, but possibly one surpassing all of the previous ranges here to really set in a full, clean bear market bottom. That is very typical here within history. If we just scroll back in the VIX here, you can see that usually you need some kind of shakeout here, right? Something up as high here as 81 points here, like back in March of 2020. Or for example, if we scroll back through history, even just taking a look at previous bull market sell-offs and corrections. I like to call them that because I don't think they're really bear markets in the definition that we're talking about here. We're talking about 50% bear markets. Even a 25, 30% bear market can sometimes see VIX spikes like here in August 2015 of 52 points. So again, if we really go back here to talking about recessionary levels, right, or depressionary levels within the VIX, that's when we get to the 75 to 100 point range here, like we did back in 2008. So don't be amazed if the VIX breaks above this range and continues charting higher. That is going to be where the real discount opportunities are. Now, one thing that I think the bulls, feel have going for them, right? They feel that essentially could be the relief for equity markets that we're looking for. That could be proof that the Fed is taming inflation, is the energy commodity prices. Now again, let's just take a look here. Take a look at oil here. We're down here again at the lows that we were back in mid-August. And I got to be honest, it looks exhausted. It looks like it wants to continue going down here, at least right now. Don't be surprised to get a fake out. That's why I say don't short these kind of levels here. But it does generally look like the bulls for equities have a little bit of sign of relief here because lower energy prices, generally speaking, or at least the narrative has been over the past couple months, that's going to be good for equities. It's a sign that the Fed won't have to raise rates so aggressively, right? Well, I want to go ahead and point towards one important reality here, guys. While it does prove that the Fed may be getting a hold on inflation, and that is great news, it is a sign that the Fed, being hawkish, raising by 75 basis points, reducing the balance sheet, engaging in quantitative tightening, they are doing the right thing. it doesn't mean that it's going to be great for equities, because this likely means that demand, like the Fed is trying to do, they are trying to cool demand, and it is starting to slow down. Demand is starting to slow in the economy. But with demand slowing down in the economy, you eventually are going to, after inflation, get recessionary stagflation. Okay, and this is where inflation, albeit maybe it isn't expanding anymore, is still keeping relatively elevated to a degree, still far away from salaries. And economic growth, the jobs market, salary growth, all these things that put disposable income on the table and bring better economic certainty for the future, all those things are starting to dwindle slowly because the economy is slowing, demand is declining. And that's the key thing here. It doesn't mean that just because commodity prices are declining, that it's going to be great for equities. We need to see a really long-term sustained decline here, and we need to see how the economy itself is going to take into account those reductions in commodity prices, because sometimes this can be an indicator here that the economy itself is slowing. And I got to be honest with you all, the Dixie, or the dollar index, is all the sign we need to see here. It does essentially mean that the Fed is leading the way. There is a dollar liquidity crunch across the world right now as the dollar index moves to its highest level, and I think as far back as over 20 years, since back in 2002. The dollar is continuing to churn higher here. This means that the Fed is in the driver's seat, or at least they're getting close to it, where they're able to pump the brakes on global demand, and this is what's, again, cooling energy prices. But what's this going to do to the global economy? Especially if the Fed continues to chart this course. They've been continuing to push the dollar towards new higher lows and higher highs. They are still in the driver's seat here, driving the Dixie forward. And as we've talked about here on the channel, we believe that this is going to go all the way up here, if we turn on our drawings, all the way here towards 117. All right, just go ahead and zoom in. All right, we had the continued range of higher base here for the Dixie, and we think that it's got a chance here sometime into the fall or into the winter, where we're going to be setting in generational highs here for the dollar index. It's a consistent level we've seen before. If you guys want to see some more details around this kind of chart and other stuff, we talk about it in the Dash report. But again, I'm just going to go ahead and share it with you guys here on the channel. We think the dollar is going higher. We have been bullish on the dollar for the past couple months. We've recommended some really great trades for the dollar against other weaker currency pairs going into this strong dollar environment. And it's not just the dollar. We can take a look here at the yields for treasuries, right? The US 2-year yield still churning higher here, its highest level, and as far back, and we actually have to go to the weekly chart here. Let's go ahead, take a look back here, and as far back as 2007. Massive, massive spikes here for the US 2-year yield. Still holding up, not budging whatsoever. If we take a look here, just nudging week by week. And the 30-year yield is what's really telling here. If we go here to the weekly chart, it's really the only chart you guys need to keep on your radar here when you're wondering about whether or not the Fed is easing or continuing to remain in the driver's seat, cooling inflation. Let's go ahead and take a look here to the 2-week and crunch down the chart here. We have had a multi-decade bear market, a multi-decade bull market in bonds due to a generation of lower interest rates, financialization in the economy, asset prices expanding, with no recourse. The Fed always coming in to help. The government always coming in to provide financial stimulus. Now the government, nor the Federal Reserve, can inject easy money. And we are reaping what we sow. We are at the highest yields that we've seen since back in 2014 on the US 30-year yield. And we have turned a multi-decade line of resistance into new support for the US 30-year yield. Now, if you guys don't know, US Treasury yields, even though I know this sounds so boring, it doesn't feel like it has to do with crypto, right? It has a lot to do with crypto and the entire financial system. The US 30-year yield is utilized in a variety of market metrics like the Sharpe ratio. It's seen as essentially a guaranteed return, right? If you essentially aren't seeing an asset perform better than US 30-year yield, why even hold it, right? and that's why the Sharpe ratio holds lots of significance. It's the kind of base rate you can get on your capital. And now it's getting incredibly difficult to find assets that are outperforming treasuries. And as bond prices get cheaper and the yields go up, the argument to invest in stocks, crypto, property, practically anything else gets very, very difficult. And it's going to continue to get difficult so long as the Fed keeps jacking up that federal funds rate. So I hope you guys enjoyed this video. If you liked my rambling, drop a big like. It's one of the best ways you guys can support the channel here. Share this video with friends or family. We always love getting more people in the DataDash community. If you want to check out any of the things we talked about earlier, from CoinPanel to Bookmap, and get some great discounts, we've got links down below in the description. And if you like my rambling here and you want to see it in written format across a variety of macro markets, definitely check out the Dash report down below in the description. You guys can get 20% off on an annual subscription. We've got over 1,000 community members contributing and making it a great place to learn about trading and investing. But that being said, everyone, thank you all so much for watching. It was great getting to speak some market talk with you guys, and I hope you all have a wonderful rest of your week. I'll see you guys in the next video on Thursday. Take care, everyone.